defensive investor can always prosper by looking patiently and calmly through the wreckage of a bear market. So said Benjamin Graham. Hey guys, I'm Jasper, a financial market analyst working with Trading 212 to help improve your financial education. Please note that nothing in this video should be construed as financial advice. You can think about investing like a football pitch. What I mean is it's split into two halves. The opposition half is a bull market, your own half is a bear market. While you're in the opposition's half, you want to score a goal and you're on the offensive. When you're in your own half, you want to be, you're saying before me, I hear you through the screen, defensive. Nice analogy, right? But what on earth does it mean? What is defensive investing?
Shield wall!
Defensive investing is an investment strategy that aims to protect your capital and minimize losses in a downturn. It involves investing in companies that are less likely to be affected by economic recession, such as those that produce essential goods or services, or have little debt, or are not entirely dependent on consumer spending. When recessions occur, the stock market often takes a hit. However, not all stocks are equally affected. Some companies tend to weather economic downturns better than others. As a result, investors allocate more of their capital to the stocks of those companies. As an investor, you can take advantage of this by investing in defensive stocks during a recession. In a recessionary environment, defensive stocks tend to outperform the overall market because they are less volatile and more stable. Now, do you want the good news or the bad news? I'm hearing bad news. It's actually not bad news, but what I want to do is start with the 4 types of stocks that tend to underperform in a recession, and so are the ones you want to avoid or own less. Number 1, cyclical stocks. These are the shares of companies that produce goods or services that are sensitive to economic cycles. For example, companies in the automotive or housing industries are typically cyclical because people tend to spend less on big ticket items when the economy is weak. These stocks are generally more volatile and risky, so they tend to do poorly in a recession. Speculative stocks. They represent companies that have not yet fully developed their products and have often yet to turn a profit, and in some cases are unlikely to do so for several years. These companies are usually startups or small businesses with high risks and high potential rewards. A good example is biotechs, which spend lots on R&D in the hopes of creating a new drug that either cures disease and gets approved by regulators, or doesn't work and it's a bust. They tend to do poorly in recession because investors are more risk averse and prefer to invest in established companies with a track record of success. 3, highly leveraged stocks. These are the stocks of companies with a lot of debt. The debt makes them more vulnerable to a downturn because if revenues fall, they may not be able to make their interest payments or meet their other financial obligations, and as a result, these stocks tend to lose a lot of value in a recession. 4, stocks of non-essential goods. These are the shares of companies that produce luxury items or discretionary items that people can live without. For example, people may cut back on buying expensive clothes or going out to eat at restaurants during a recession. These stocks tend to underperform in economic downturns because often people have less money to spend. Phew. With those out of the way, we can look at 5 industries that might be best suited for defensive investing. Number 1, healthcare. People need to take care of their health regardless of the state of the economy. People still need to go to the doctor or buy medicines even when times are tough. That means these companies tend to be less volatile and stable, and making them more suitable for defensive investments. Number 2, utilities are often another example of companies that provide essential goods and services that people need regardless of the state of the economy. These companies are also typically less volatile and more stable, making them suitable defensive investments. For example, an electric utility company is likely to do well when times are good, thanks to increasing demand for power supply. But of course, people still need electricity even when the economy is weak. Number 3, consumer staples. Consumer staples are companies that produce goods that people regularly need, such as food and household items. Most households, even those on a tight budget, will still need to buy these items during a recession. As a result, consumer staples tend to do well in an economic downturn. For example, food giant Kraft Heinz has a history of outperforming the market even during recessions. In addition, chains like Walmart and Costco, which sell various essential goods, have also outperformed the market during the past downturns. Number 4, telecommunications. These companies are yet another example of businesses that provide essential goods and services that people need regardless of the state of the economy. Thanks to the advancements of technology, people now rely on telecommunications companies more than ever before. While the industry is not entirely recession-proof, it has still outperformed the market during past downturns. For example, telecom giant Verizon has a history of outperforming the market even during recessions. The company's current 5G expansion is set to boost its revenues and performance despite the economic decline. Number 5, infrastructure and transportation. Infrastructure companies build and maintain roads, bridges, railways, and other forms of transportation. These companies play a vital role in keeping the economy moving, even during a recession. Recession or not, people still need to get around and businesses still need to transport goods. As a result, these companies have tended to do well during past economic downturns. Another way to look at this is that infrastructure and transportation companies are often seen as defensive investments because they provide essential goods and services that the economy needs. So how do we use this information about defensive and non-defensive industries? As you can imagine, hedge funds and pension funds pay the big bucks to their analysts to answer these exact types of questions. But actually you can keep it relatively simple, especially if you're investing with trading in 2-on-2 and have the help of tools like pies. Even if you're not using pies yet, you can still think of your portfolio as pie. It could be an apple pie, steak and kidney pie, however you like it.
No kidding, this is not pot pie.
In the long term, it's still going to taste just as good because you're just going to slice it up differently depending on whether you're on the offense or the defense. I like this pretty simple example from BlackRock. The blue is your defensive stocks as we've just categorized them, and the black are the non-defensive or growth stocks. You ideally want to be more conservative in a recession and then more aggressive when the economy is strong. But picking the right sectors is not enough. Being in the right kind of stocks for a recession needs to be done with specific defensive strategies in keeping with your long-term goals. Here are 4 strategies to focus on during a recession. First, prioritize quality. When looking for stocks to invest in during a recession, when companies are more likely to go out of business, it's important to invest in quality businesses. That means investing in well-established and stable companies with a history of weathering economic downturns. With trading 2-on-2, it's very easy to make an audit of your stock portfolio to see which stocks are high quality and which are not. But how do you define high quality? There are a few key factors you should look for. A strong balance sheet. This means the company has little debt and a lot of cash on hand. This gives the company financial flexibility to weather an economic downturn. A history of profitability. There's stable profit margins. These show that the company can generate profits even in tough economic times. A diversified business. This means the company has multiple revenue streams and it's not reliant on just one product or service. An always in demand product or service. This means people still want or need what the company provides even when the economy is weak. Number 2, diversify your portfolio. Another critical strategy for defensive investing is diversify your portfolio. This means investing in various industries and companies so that you're not putting all your eggs in one basket. For example, if you only invest in a couple of stocks that you think have strong growth potential, you're taking significantly higher risk than if you had, say, 20 stocks. In a recession, those 2 businesses are more likely to get into difficulties than when the economy is strong. When you own shares in, say, 20 businesses, there is a good chance that some of them will manage the recession well. Similarly, it would help if you diversified your portfolio across different asset classes such as stocks, bonds, and cash. This way, if one asset class falls in value during a recession, you still have other investments to cushion the blow. Third strategy, dollar cost average. The point about this one is just not to stop. If you want the ultimate benefit from investing, which is compounding returns, you want to always be adding to your investments over time. The silver lining to a recession and a downturn in the market is that you can dollar cost average into your investments. By investing a fixed amount of money into your chosen assets regularly, such as monthly or quarterly, you'll be buying when markets are down and you can lower your average buying price. Using this approach can help reduce the risk of buying shares at the wrong time and can also help build up your position over time. And 4, fundamental analysis. Finding defensive stocks to invest in requires some fundamental analysis. This is where the benefits of this video end and where we as individual investors should put the work in ourselves. It involves looking at companies' financial statements and other key indicators to assess its health and prospects. But like I've said in other videos, there's no harm in taking advice or reading research by others to save time, so long as you check it out yourself. There's no guaranteed way to protect your portfolio during a recession, but investing in industries that have outperformed in the past recessions while adopting these 4 strategies will help you build a defensive portfolio that should weather a recession better than if you'd not taken any action at all to get defensive. I'm all done talking about defensive investing for now, but what about you? What's your favorite defensive stock? Share the ticker with the 880,000 and growing Trading 212 YouTube subscribers in a comment below. And if you like this video, please make sure to smash the like button, subscribe, and hit the bell icon so that you see more videos like these as soon as they're released. Thank you very much for watching and happy investing.